Let me introduce you to the person who now controls your mortgage rate, your savings account yield, your credit card interest, and the single most important economic lever in the entire global financial system. His name is Kevin Warsh, and as of today, May 13, 2026, he is almost certainly your new Federal Reserve Chair. The Senate voted 51-45 to confirm Warsh to the Federal Reserve's Board of Governors. The vote on his confirmation as chair is expected today. Jerome Powell's term as chair officially ends this Friday, May 15th. Most people have no idea this is happening. Most people are watching Iran war updates, checking their portfolio and stress-eating at their desk. And meanwhile, the most consequential financial appointment in a generation just cleared its final vote in a mostly empty Senate chamber, and almost nobody outside of Wall Street is paying attention. That is a mistake. Because what Kevin Warsh does in the next 6 months will affect your financial life more directly than almost any other single event of 2026. So let's talk about who he is, what he wants, and why the market is now pricing something it has not priced in years. A rate hike. The CME FedWatch tool currently shows a 30% probability that the Federal Reserve may raise interest rates by December 2026, not cut, raise. In an economy already bruised by $100 oil, 3.8% inflation, a frozen labor market, and an active war in the Middle East, 30% probability of rates going higher. That number was essentially 0 3 months ago, and it is moving in one direction. Here is what happened this week that lit the fuse on all of this. The April Consumer Price Index rose 3.8% year over year, higher than the consensus estimate of 3.7% and the highest annual increase since May 2023. Core CPI, which excludes food and energy, rose 2.8% annually, well above the Fed's 2% target. Month over month, headline CPI rose 0.6%, the highest monthly reading since May 2023. 3.8% headline, 2.8% core, both moving in the wrong direction. And here is the part that should genuinely alarm you. Core inflation, the number the Fed watches most carefully because it strips out volatile energy prices, is accelerating. That means even without oil, even without the war, even without Iran, underlying price pressures in the American economy are building. The Iran war poured gasoline on a fire that was already burning. Inflation was already broadly accelerating before the closing of the Strait of Hormuz. The supply shock just exacerbates that underlying trend. New Fed Chair Kevin Warsh will certainly have a harder time framing the case for rate cuts in this environment. Now let's talk about Warsh, because this man is not Jerome Powell. He is not a careful, institutional, follow the data and speak in complete paragraphs kind of central banker. He is something the Fed has not seen in a very long time. Warsh says he plans regime change at the Fed, including tightening its coordination with the Treasury Department and the Trump administration on non-monetary policies and setting the central bank on course for a smaller balance sheet. Regime change. Those are his words, not a metaphor someone applied to him, not spin from his critics, his own words, describing his own intentions, for the institution that controls the cost of every dollar borrowed in America. Warsh's priorities appear to be a return to the Fed's core mandate, a stricter approach to inflation targeting, and a reduced reliance on quantitative easing and forward guidance. He has called for a broader reassessment of how inflation is measured and wants to abandon the dot plot, the chart Fed officials use to signal their expectations for future policy moves. No more dot plot, no more forward guidance, no more being able to read Fed tea leaves in advance. For investors and analysts who have spent 15 years decoding Fed communications to position their portfolios, this is not a small procedural change. This is the removal of a navigation system from a plane mid-flight. And here is the political tightrope Warsh is walking that makes this genuinely dangerous in real time. Trump nominated him specifically because Trump wants lower interest rates. Trump has been pressuring the Fed on rates publicly and aggressively for years. Trump said in December 2025 that he would only appoint someone to lead the Fed if they agreed with him on interest rates. Senator Elizabeth Warren accused Warsh of being a, quote, sock puppet for Trump, an assertion he denied. But legendary hedge fund manager Paul Tudor Jones assessed there is very little probability Warsh will do as Trump wishes and lower rates immediately, saying he would want to see the data and that Warsh will be constrained. Counterintuitively, Warsh's finance background could reinforce his prior hawkish leanings, leading to more independence from Trump on inflation. If inflation reaccelerates, he may find himself compelled to raise interest rates, doing precisely the opposite of what the president who nominated him had in mind. Let that sit for a second. Trump picked Warsh specifically to get lower rates. Warsh might end up raising rates because the inflation math forces his hand, and if he does, the political fallout from that, a Trump-appointed Fed chair hiking rates against Trump's explicit wishes, is a level of institutional drama that has no modern precedent. Powell indicated at his last Fed meeting that the central bank could be a long way off from lowering rates given inflation concerns. Powell plans to take the unusual step of staying on as a governor after his term as chair ends, in response to what he described as legal attacks on the Fed that threaten its ability to conduct monetary policy without political factors. Powell staying as governor while his replacement as chair walks in the door. In any other era, that would be the lead story on every financial news channel for a week. Right now, it is a footnote under the oil price ticker. Now let's connect all of this to your actual money, because this is not abstract institutional drama. This is your mortgage, your car loan, your credit card, and your savings account. If Warsh turns out to be genuinely hawkish, if the inflation data forces him to hold rates or even hike, then the rate relief that millions of Americans have been waiting for since 2022 gets pushed further into the future. Mortgage rates stay above 6.5%. Small business lending stays expensive. Credit card rates stay near 20%. Every American carrying variable rate debt continues absorbing the cost of an inflation fight that started 2 years ago and has now been reignited by a war. If Warsh bends to political pressure and cuts rates into 3.8% inflation, he risks unleashing a second inflation wave that would be genuinely harder to contain than the first one. Markets would lose confidence in Fed independence. The dollar would weaken further. Gold, already at $47.54, would rocket. And the cost of living crisis that has been slowly grinding down working-class Americans for 3 years gets a second wind. There is no clean outcome here. There is only which version of bad is more manageable. Meanwhile, the rest of this week's news is not exactly calming the room. Trump warned the fragile U.S.-Iran truce is on life support. Oil climbed back above $100 per barrel. Qualcomm plummeted 13%, Intel dropped 8%, and the iShares semiconductor ETF sank 5% in a single session. The chip rally that carried markets to record highs last week reversed violently. eBay rejected GameStop's $56 billion takeover bid outright, with Chairman Paul Pressler writing that the board concluded the proposal is neither credible nor attractive. GameStop tried to buy eBay. eBay said no with the energy of someone blocking a number. And the broader market is sitting in a holding pattern where every piece of good news gets immediately offset by something that reminds everyone the underlying situation is genuinely fragile. Here is the complete picture as of today, May 13, 2026. Inflation is 3.8% and accelerating. Oil is back above $100. The ceasefire is on life support. The chip sector just lost 10% of its gains in 2 days, and the person about to take control of the Federal Reserve has publicly called for regime change, wants to eliminate the communication tools investors rely on, and is walking into his first day carrying an inflation number that gives him almost no room to maneuver in the direction his boss is demanding. Warsh himself called inflation the most regressive tax anyone in Washington could come up with, saying it does the most harm to the least well-off among us. That is exactly right. Inflation is a tax on people who cannot hedge it. People who do not own gold, do not own real estate, do not have stock portfolios sitting at all-time highs. The people whose wages have not kept pace. The people paying $4 gas and watching the grocery bill climb and wondering why their paycheck feels smaller, even though the number on it did not change. Those people are the ones with the most riding on what Kevin Warsh does next, and they are the least likely to know his name today. So here is what I want to know from you. Do you think Warsh stays hawkish and holds or hikes rates to fight inflation, even if it puts him directly at odds with the president who nominated him? Do you think the political pressure wins and he cuts anyway, risking a second inflation wave? Or do you think the Iran situation resolves fast enough that the question becomes irrelevant and the Fed gets its clean data before the June 17th meeting? Drop it in the comments. Because the next Fed chair just got confirmed on the same day the ceasefire went on life support and CPI came in hot. The calendar does not care about your comfort, and neither does inflation.